the yield curve? This is one of those finance terms that sounds super technical, but is actually really simple. The first thing you have to understand is this: the length of a loan impacts the loan's interest rate. This is likely a concept that many of you are familiar with because you run into it all the time. A 7-year car loan probably has a higher interest rate than a 3-year car loan. The interest rate on a 15-year mortgage will likely be lower than the interest rate on a 30-year mortgage. This is because the longer the loan, the more risk there is for the lender. So the lender wants to be compensated for that risk with a higher interest rate or yield. Longer loan means higher rate. So when someone references the yield curve, all they are talking about is a dot plot showing the interest rate that a lender would charge for different periods of time. The dot plot starts with the interest rate for the shortest maturity, the shortest loan length, and it continues until it reaches the interest rate for the longest maturity, the longest loan length. And so when you plot all of these dots representing the interest rate you charge for each length of time, it creates a curve. So this is the normal yield curve, and it shows how interest rates change with bond or loan maturity. Now, when financial analysts and investors are talking about the yield curve, they're generally talking about treasury rates and treasury bonds. In finance, treasury rates are kind of the benchmark that we compare most fixed rate loans and bonds to. So the yield curve is important as a benchmark. Now, it can also flash us warning signs in times of economic uncertainty, and we call these flashes yield curve inversions. An inversion is when a longer term bond is actually paying a lower rate or yield than a short term bond. That's the yield curve inversion. It's weird because it means investors expect trouble ahead, like slower growth or even recession. So they're locking in long-term bond rates for safety, even if it's providing a lower yield than what they could get on a short-term security. Now, an inversion doesn't mean a downturn is guaranteed, but it is a red flag that economists watch closely. Two of the most watched inversions are the 10-year versus the 2-year and the 10-year versus the 3-month. 10-year versus 2-year treasury is popular because it reflects medium and long-term expectations. 10-year versus 3-month treasury is considered even more predictive of a recession. So next time you hear someone talk about the yield curve, you'll know exactly what they mean.